How do I build the right portfolio for me? Taking into consideration my personal situation, not copy someone else, not copy someone else's portfolio, not copy someone else's risk profile. Have an actual portfolio designed to your own personal circumstances. It's crazy. The amount of people that I see out there having portfolios that are designed not for them, and then they complain about the results of those portfolios. This is what I do. I think about this in really, really simple terms. I say I have 20 positions, right? Or, I look at it and go, I have a 60-40 split, right? So I have, say, 4 companies that are in growth company space. And for a growth company space, I look at it and go, high growth companies, they have to have year-on-year revenue growth of between 10 and 20%. So if we look at, one of my favorite stocks that I've owned for such a long time, like, I don't know, more than 5 years, right? Look at Alphabet, right? Look at Google. I use Google every single day. I'm using it right now. I'm literally using Google right now, right? Up 120%. That's because all the legal problems have all passed. But more importantly, look at the revenue growth. Who's not happy with that level of revenue growth? It's such an easy hold. Owning this type of quality company, even if we look at over a 5-year period, nobody's complaining. It's such an easy one, right? Such an easy investment. And that forms one of 4 of my, high growth type of stocks, right? And in that case, I've done exceptionally well over the last 12 months. And then my second classification of growth stocks is ones that are doing between 5 and 10% in revenue growth per year. So again, I actually picked the worst performer. I picked the worst performer here, and I go, worst performer of my 4, lower growth portfolio ones, and look at the revenue growth is just under 10%, just under 10%. Share price is down -2. And I picked this one. I think Macca's is a quality company. I think it does really, really great stuff. But I picked this one to show you that in this classification, in my next bracket of 4 stocks, even in a bad year, it only went -2% down. Why? Because the revenue growth, because of the actual growth of their business, because of what they're doing in a bad year, it hasn't gone down by that much. And then, a couple of months ago, it was up over 10%. So what I want to highlight here is that if we have the right stocks in the right classifications, even when it doesn't go according to plan, it's not devastating. It's not like you're down by 30% or 50% on one stock, 70% down because, you built the portfolio wrong, right? And then we think about it. Say we then have 4 defensive stocks. Now, 4 defensive stocks that what I'm trying to get at here is when I have 4 defensive stocks is that it's up by 10% or it's down by 10% in a year. It's pretty flat and even. And one great example of a defensive stock here would be like CBA. I bang on about the banks in Australia and I talk about them quite often or in a negative term. But in this context, if we think about this one, we would say that it's really expensive 12 months ago. I still think it's expensive today. I've owned this one. I've owned CBA for, I don't know, 10 years. We've been invested in CBA for 10 years, but I don't, maybe even more. It's such an easy company to own in Australia. It's one of the best performing Australian stocks that we've got. It's so easy to own. They give out a dividend. They quote are expensive, right? But they continuously perform. But for me, I classify this as one of my defensive stocks. I think about it over the long term. I know in 5 years' time, even if I buy it today $180, in 5 years' time, I'm going to be quite happy to own it. I'm not going to see much volatility. I might be up by, again, my idea here is it's up by 5-10% per year, down by 5 or 10% per year. If we look at if we look at how consistent it is over a long period of time, it very rarely has massive drops. We did have, if we look all the way back to COVID, big drop, makes sense. It's COVID. Nothing was stopped there. The Royal Commission, global financial crisis, all those things, but it very rarely has a bad year when the market's not getting hit. And then I'd think about 4 stocks. So 4 stocks that I would have as like my capital notes to bring some form of cash and equivalent to the portfolio. And then what I would want to have is 20% of my portfolio sitting in cash to take opportunities. And sometimes I'd have up to 4 opportunities going at once. And opportunities mean, and this happens so many times, it's like buying Westpac at 8% discount, right? I buy it at 8% discount, I hold on to it for a week and I sell it because of a placement. So I get a placement at Westpac, 8% discount, hold on to it for a week, I make 8%, and it's opportunistic, right? I have to have physical money in the bank account. So I normally hold 20% for that. It's my best return on investment for an asset class. So that 20% that I leave in cash majority of the year is at the highest rate of return out of my whole portfolio. It's so freaking easy, right? So easy. Even Whitefield's up the other day, 9% 1 week. Simple. In, buy, in, out. Again, I get it. Sophisticated offering. You have to have your professional. Think about this. Like Whitefield's up 9% in a week. So I put a couple 100,000, say 200,000 into Whitefield's up 9%, $18,000. That's half the amount of money that I pay in fees to my broker, paid by one transaction in a 1 week period. And people try to tell me that fees are expensive to have a professional that are managing this, that are looking after you. I'm like, it's expensive not to. It's expensive to own stock that goes down by 30, 50, 60%. I got a client, 171,000 he invested in one stock, or lost 171,000 in one stock, down 53% because he didn't get out. You can see in the emails, last year I told him that's very risky. What you're doing is very high risk portfolio. I don't know why you're investing that much in those industries. It's crazy. Think about sector allocation, right? 80% of your returns come from a sector allocation. People who got out of the technology space in the last 12 months, their portfolios would be rat all the way down in the gutters. Technology has been the easiest sector to make money on in the last 12 months. So it blows my mind that people exited. It blows my mind people exited the US market since Donald Trump got elected. It made so much money. It was so freaking easy. When we're building the right portfolio, it shouldn't be, your performance shouldn't be all over the place. You shouldn't have stocks that are going down by 20, 30, 50% in a year. It means that you have a wrong asset allocation. It means you've invested in the wrong things. It means your risk profile is completely wrong. I don't know. I'm okay to pay my fees. I pay 30, 40,000 a year in fees per year. I get the right advice. I get the right outcome. And that's why my share portfolio has continued to outperform over the long period of time. I'm Gary Brown. Keep investing and take control of your financial future.